What does that tell us about when we're going to see a shift in actual real cash rates in Australia?
Look, I think the expectation is that we're still some 24 months away before we get to see the cash rate move. I know that, and me included, was wondering whether or not the RBA was actually going to be able to hold its stance for as long as it really has been saying it was going to in all its forward guidance. In particular, because you're seeing the labour market tighten quite dramatically, as well as inflation start to tick up, both indicators that the Reserve Bank governor is looking to target and improve as the economy strengthens. However, quite clearly, the Reserve Bank wants to see the inflation and unemployment rates reduce and stabilise at levels that they're now trying to target, as opposed to make any sort of preemptive move prior to reaching those levels.
Yeah, because the RBA is saying the central scenario for the economy is that that condition will not be met before 2024. But could the RBA be wrong-footed like some of the other central banks that we've seen around the world, in particular the Fed? You mentioned the tight labour market. We've got unemployment at 5.1%. We are seeing inflation creeping up globally. We've got oil prices now at the highest level in around about 3 years. The commodity picture when it comes to iron ore prices doesn't look like it's going to cool down anytime soon. So what do you think? Could they be wrong-footed and 2024 perhaps be a little bit too far out on the horizon? And I know that in a rare appearance today, the RBA governor will be speaking in a couple of hours' time from now. How is he going to address those concerns?
Look, I think the fact that the Fed is now suggesting that it's likely to have 2 rate rises over the next 2 years doesn't necessarily mean that it's been wrong-footed. It's just and 2 rate rises aren't a large increase at all when you're looking to have a more normalised monetary policy setting. What you are recognising, or what the Fed has recognised, is that their inflationary targets are going to be transitory, that we are getting a spike of inflation this year, and the likelihood is that it's still going to come back down to a more normal period and still be around the lower end of their target range. So again, I think central banks the world over may realise that there's spikes in growth occurring in the short term, but what they're wanting to see is sustained levels of economic activity that are driving wages and inflation up and being kept within their target ranges.